An Iranian retaliatory strike against Israel is imminent and is increasingly likely to come this week. This is the latest news out of the US and also out of Israel. And I want to show you in today's video how we can be prepared for this as investors and some of the assets we could be looking at allocating into ahead of any coming escalation in the Middle East. US-Israel view an attack by Iran as increasingly likely. Region braces for strike as leaders urge de-escalation. Pentagon deploys submarine with cruise missiles to the region. Bloomberg goes on to report that the US believes an Iranian attack against Israel has grown even more likely and may come as soon as this week, officials said. As allied leaders sought to head off all-out war and the Pentagon deployed more forces to the region. Briefing reporters Monday, White House spokesman John Kirby said the US and its allies have to be prepared for what could be a significant set of attacks. Israel believes it's increasingly likely that there'll be an attack by Iran and its proxies, Kirby said. We share those concerns. So how does this affect financial markets? What should we be looking at as investors? What should we be paying attention to if we're going to see an escalation, as looks likely, although of course let's all hope things do de-escalate. But as investors with no control over these things, what do we do? What do we look out for if this situation does begin to escalate as early as this week? Well, this Business Insider headline gets right to the point, which is that oil and natural gas prices could spike as much as 40% this year if war spreads across the Middle East. The potential impact of a disruption on supply on energy prices depends on the duration and severity of the disruption. While it is difficult to predict by how much and for how long energy prices would rise, we assume that oil and natural gas prices surged by 40% in 2024. And this is from the Institute of International Finance, the chief economist, Garbis Iradian. Along with the increase in oil and natural gas, freight and insurance costs would increase considerably, creating inflationary pressures at a time when inflation remains above target. So we can see the two key takeaways are that one, any escalation in the Middle East will, in all likelihood, result in a significant surge in energy prices, crude oil as the main thing we're going to be looking at in today's video and discussing. And also, alongside that, the second thing is that this would create a wider inflationary regime. So in terms of the overall regime, themes you can look for is certainly things that could benefit an inflationary regime. But we're going to look at the crude oil price. We're also going to look at some of the individual stocks that I think could definitely benefit from any escalation in the Middle East. First of all, let's just look at the effects on the S&P. So we'll go from the overall regime level, this kind of spike in crude oil, inflation regime. We're going to look at how that's most likely going to affect the S&P 500. And then we'll drop down and look at some of those individual stocks that we could potentially position into or allocate into that could benefit from any escalation in these tensions in the Middle East. So let's have a quick look at the timeline of events leading up to the current situation and how those events affected the S&P 500 along the way. And the tension started around April the 2nd when Iran said Israel had bombed its embassy in Syria, killing some of its commanders. Suspected Israeli warplanes bombed Iran's embassy in Syria on Monday in a strike that Iran said killed 7 of its military advisors, including 3 senior commanders, marking a major escalation in Israel's war with its regional adversaries, as Reuters reported at the time. So if we have a look at the S&P 500, and you can see I've marked April the 1st when we got that initial strike from Israel, and you can see we got a gap down straight away the next day, and this was actually the top of that run-up in the S&P 500. So quite clearly we saw risk off coming into the US benchmarks pretty much straight away, in fact the very next day. And so why is that the case? Why do we start to see, as crude oil goes up on escalating Middle East tensions, why do we start to see US stocks gapping down, selling off, risk off coming into the US benchmarks? It's because as crude oil goes up, this is inflationary, and yields, interest rates in the US have to go up because of it. And as yields go up, as interest rates go up in the US because crude oil is going up, this brings in risk off to the US benchmarks, and it's bearish for the indices. Then on the 14th of April, Iran retaliates. Iran launches over 200 drones, ballistic and cruise missiles towards Israel in first ever direct attack. The article went on to say Iran has fired a massive swarm of more than 200 killer drones as well as ballistic and cruise missiles towards Israel, the Israeli military has said, igniting fears of a region-wide war. It is Tehran's first ever direct attack on Israel's soil, officials confirmed, which comes amid boiling tensions following the country's devastating 6-month war in Gaza. So when that Iranian response came, dubbed Operation True Promise, you can see the following days we have an acceleration in the sell-off of the S&P 500. So what we're seeing along this timeline is as tensions in the Middle East escalate, so too does the downward pressure on the S&P 500 during this time. We then see an Israeli response on April the 18th, Iran targeted in aerial attack. The attack on Iran early Friday was likely intended as both a retaliatory measure and a cautionary message, a retired US Army Major General told CNN. For days, Israel has been weighing its response to unprecedented weekend strikes from Iran, which were launched in retaliation for a suspected Israeli strike on its embassy compound in Syria earlier this month. And then what happens on the 19th is we get reports that Tehran plays down reported Israeli attacks, signals no retaliation. And what happens if we pull up a chart of the S&P 500 and mark Friday the 19th when we get the Tehran response to downplay the strike and say there's no retaliation? That is the bottom of the correction in the S&P 500. So we can see it's pretty clear by looking at the history of this current tension in the Middle East between Iran and Israel and overlaying that onto the S&P 500 that any escalation is absolutely going to be negative for US stocks in general, looking at the benchmarks. And we should expect this to weigh on the S&P 500. We should expect to see further downside in the S&P 500 until and unless we get a de-escalation and an end to the tensions between Iran and Israel. Just like on Friday the 19th, if that comes, we should expect that to be positive for the S&P 500 and for stocks in general. So let's go and have a look at where we are today then, ahead of a potential retaliatory strike by Iran. You can see on the 31st of July, tensions were ignited once again. Hamas leader Ismail Haniyeh assassinated in Tehran strike. Hamas political leader Ismail Haniyeh was assassinated in the early hours of the morning in Iran, the Palestinian terror group said on Wednesday, describing the strike as a severe escalation that would not achieve its goals. And if we go and have a look at the S&P 500, you can see Wednesday the 31st, this was just before we got the big leg down in the S&P 500. And I described in previous videos how this was due to the yen carry trade unwinding and also non-farm payrolls, which saw a weaker dollar, which exacerbated the yen carry trade, added strength to the yen. But one thing which is overlooked is that we also had that Israeli assassination right before that decline. And all of these things combined really created a bit of a perfect storm, which is why we saw that big spike in volatility at the start of August. So now we know the general regime would be an inflationary one. This would be risk off, bearish for equities. Why? Because as an inflationary regime kicks in, yields, interest rates in the US would have to go up to counter any new inflation regime. And of course, an increase in interest rates is bearish for the S&P 500, for the NASDAQ, for US benchmarks and stocks in general, especially those sensitive to interest rates. So with that in mind, let's now go and have a look at some of the assets that would benefit from any escalating tension in the Middle East in the near future. So the first asset we're going to look at is the obvious one, crude oil. We've already highlighted this as being one of the major beneficiaries of any escalation in tensions between Iran and Israel. And we've seen crude oil spiking 4-5% during the recent escalations between Iran and Israel previously. So any escalation between Iran and Israel now is likely to spark a rally in crude oil. And what's very interesting about this is looking at the monthly chart that we're looking at now, you can see that we failed previously to make a low. Now, what this entails is that usually when you fail to make a low in an asset, if you start to rally and you start to break the high of what in this case is a wave one, which is highlighted in the chart, very often you can see stop losses being taken out by shorts and you get that kind of breakout momentum, which turns into a third wave. And very often this pattern precedes much larger moves in assets. Now, the second thing to note with this is the crude oil monthly chart is also showing that since the 2021 run-up in crude oil, we've really been correcting and pulling back and retesting the prior broken high at the 65.40. So a monthly technical setup with broken resistance now turning support, or in fact, months ago turning support back in 2023. But it's primed, especially with a catalyst, is primed for a much bigger rally to the upside. And this is very, very interesting because we now have a major technical setup which can be sparked by a fundamental catalyst. And when you get that, major technical setups and a fundamental catalyst, this very often precedes much bigger moves in assets. And so if we jump over to the hedge-quantitative trading platform, you can see the major high here highlighted at the 95.52 roughly. That's that monthly high of the potential one wave in the monthly chart. And if we break here, you're going to get all of these people with stop losses over here. They're going to be taken out. You're going to see short covering, and you'll see new breakout traders likely stepping in. And those mechanics, those breakout mechanics, are what catalyze those big impulsive moves. Many of you will know them or refer to them as third waves. So as it currently stands, we bounced right off of the monthly lower bound in the hedge-trading platform. That would have been a fantastic opportunity to get involved before this reversal. However, we're now crossing back over the daily 200 moving average. And what I expect will probably happen is we'll probably get some more upside and a consolidation above. You very often see that. You break above it, you consolidate. A consolidation above the 200 daily moving average, and then this pullback would be an opportunity to get back involved. Don't forget, we cover crude oil every single week in the weekly Forex forecast. So in future weekly Forex forecast videos, keep an eye out for the weekly test of the lower bound, because that might be the very next best opportunity to get involved with crude oil to the upside. So outside of crude oil, what else could benefit from any kind of escalation in the Middle East? Well, crude oil derivatives for a start, so oil stocks. So one interesting setup is EOG Resources. This is a big oil and gas producer in the US. And as you can see on a technical chart on the weekly time horizon, we're above the 200 moving average, just as a kind of basic guide. And we've also got this consolidation pattern. We've been coiling, correcting. And those of you who are technicians will know that when you get a coiling of a pattern, or you get a consolidation, or volatility starts to dry up, very often that precedes an expansion of volatility or bigger moves. So you can see once, twice, we've actually attempted to break the prior high over here of the 136.68, and we failed to do so. Now, if we get a catalyst, if we get a bullish catalyst because we see a surge in energy prices, EOG could very well break this pattern to the upside, and that could easily kickstart the next leg up of a much bigger move in this market. The next interesting chart in oil stock is Oxy. Now, the reason I like this one is because we also have a technical pattern. And very often when you're looking at trading themes, what you really want to do is you want to combine major technical patterns with fundamental catalysts. You know, that's where you get the bigger moves. And you might position trade that and try and hold on to it and ride it, or you might just short-term trade it, you know, along the way. But either way, when you have those big technical setups on a weekly or monthly chart, and then you get a fundamental catalyst, this is where you tend to see the bigger moves. Now, you can see here that we have been testing the lows, and we've been failing every time we bounce. So we came down and we tested it again with a first degree breakout. First degree breakout is something we go through in the GMT course as part of the GMT membership. But this is essentially the weakest type of breakout. It's where you break a low and you immediately close back above the breakout point within one candle. It's the weakest possible breakout you can get. And we've done that now twice below this low over here. So it does look like this low is holding technically. And if we get that fundamental catalyst of a surge in energy prices, this is another market on the weekly time horizon we could be looking at a much bigger move to the upside. So if you are looking for potential opportunities in oil stocks, just bear something in mind. One of the reasons why I've had a look here at Oxy and also EOG is because they do not have a large amount of exposure to the Middle East like some of the other oil stocks do. And so what I've done is I've put a list in the comment below as to the oil stocks which have quite a lot of exposure to the Middle East, because yes, the oil price might go up, but if they have refineries attacked or any of their services are disrupted in the Middle East, this could actually have a negative impact on the stock. So the other thing to take away from this is that if you are looking for a crude oil play on any kind of escalation in the Middle East, it's probably better to look at the underlying commodity, i.e. crude oil to the upside, than a stock, because stocks also have inherent business risk as well. And so the final thing we could look at, which could potentially benefit from any escalation in the Middle East, is US defense stocks, because if there is going to be an escalation between Israel and Iran, the US will almost certainly help Israel since it's its ally, and it would likely do so either militarily or simply by supplying weaponry, very much like it's doing in Ukraine. So the first defense stock we're looking at here out of the US is Lockheed Martin. Now, Lockheed Martin is the maker of the famous Patriot system. They specialize in missile defense, etc. And what I find very interesting about this chart is we've already started to break out. And you can see here a pattern that I referenced earlier in the video when we were talking about crude oil, where we failed to make the low. We're kind of bouncing along the 200 moving average, and this is in the weekly time horizon, and we failed to make a low. And what happens is that failure to make a low catalyzes a break of the prior high, and I highlighted this as the one wave in the crude oil chart we looked at earlier. And after we break that, we get short covering, and at the same time we get breakout traders stepping in, and we get a major momentum move. And this is the breakout mechanics, exactly as I was talking about earlier, which we could very well see in crude oil if any escalation in the Middle East lights the fuse of crude oil and we start to see crude oil rallying. So Lockheed Martin is likely going to be a beneficiary from any escalation. It is quite near the high. I would like to see this pull back, and I haven't got the levels on here, even though we are in the hedge dash system. And any kind of pullback in this area, into a lower bound in the weekly time horizon would be very likely a better opportunity for anybody looking to be long than to jump in at the high over here. The next market we're looking at is RTX Corp, and this is formerly Raytheon. And this is an asset that has been attempting and failing to break its 2020 COVID crash highs pretty much since 2020. We've tested it once, tested it twice, tried to test it a few times, failed. And now, for the first time, we've actually broken out in 2024, pulled back, retested, broken resistance, turning support at the 99.71 roughly, and we've started to rally from this level. And this is what looks like a major breakout taking place in RTX. And I think this speaks to the market concerns around a further escalation between Iran and Israel, and how the market is already positioning in large part for a potential escalation. And the final asset we're going to look at is Northrop Grumman. And I think this is my favorite asset out of all the ones we've looked at for a couple of reasons. One, it specializes in drone technology, cybersecurity, and is likely to be a beneficiary of any kind of escalation in the Middle East. And at the same time, this is a stock that has, on the weekly time horizon, been trading into its 200 moving average, and we've seen those other stocks rallying from that area. It's a very common area for stocks to rally from. And not only that, we're breaking out of this very tight consolidation, this range which we've been in pretty much since 2023. And you can see we've attempted to break this high multiple times, and now with tensions rising in the Middle East, we're starting to get a breakout in this asset. So from the top down, we've now had a look at why there's a real risk of escalation in the Middle East between Iran and Israel, how this is going to affect the overall regime, which would be inflationary were we to get a supply shock in crude oil, how that would affect the US stock market in general, the benchmarks, looking at the S&P 500, and then dropping down to the individual stock level to see which assets might outperform in that situation. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge Hedge Dash trading app used in today's video by heading over to www.hedgedash.com. Access to the cutting-edge Hedge Dash platform is included with every GMT membership.